You've heard the old saying, the only things sure in life are death and taxes. However, there might be some ways that you can minimize taxes, and that's what we're talking about on today's show. 5 easy ways to potentially minimize your taxes in retirement. Hi, I'm Jim Martin, a financial advisor and the founder of Martin Wealth Solutions, a firm completely committed to helping people plan for and enjoy retirement. And if there's one question, one point that retirees like to underline when I meet with them, is they all want to pay less in taxes. They want to figure out ways that they don't have to write their least favorite uncle a check for any more money than they have to. And that's what we're talking about on today's show. 5 easy ways that you can minimize your taxes in retirement. So let's talk about number 1 on our list, Social Security optimization. Believe it or not, you do have control or at least influence on how much of your Social Security will be subjected to taxation. Let's start with the basics. Social Security is taxed under a rate called provisional income. While most of us are used to paying taxes under the part of the tax code called ordinary income, Social Security has its own little carve-out called provisional income. And based upon how much income you earn will determine on how much of your Social Security benefit is subjected to taxation. The more money you make, the higher the percentage of your Social Security will be subjected to taxation. Now, with that said, you do have some influence on it. Let me give you an example. Let's imagine you have your Social Security benefit and you need to take money from your IRAs in order to supplement your income. What if you withdrew that money from a non-qualified account, a CD, a checking account, or a brokerage account, and then had no additional ordinary income? That would potentially lower your taxes on your Social Security and work to minimize your taxes. And what that does is it opens some doors to allow you to leverage that tax savings potentially in other parts of your life. Maybe you'll save money on the Affordable Health Care Act by getting an incentive or a subsidy based upon your income. It might allow you to do a Roth conversion and convert more of your traditional IRA dollars because your income's lower. Whatever the case is, whether you just want to pay less or you want to leverage the tax break somewhere else in your financial future, minimizing your Social Security taxes, optimizing your Social Security planning can pay benefits and could potentially lower or minimize your taxes in retirement just by optimizing your Social Security. Now, number 2 on our list is withdrawal order. Believe it or not, the order in which you withdraw funds from your accounts can have an impact and potentially increase or minimize taxes in retirement. Now, let me give you an example. Let's imagine you're taking Social Security. So you have distributions coming from Social Security and you're receiving a check every month. Because of the way Social Security is taxed under the provisional income code, depending upon which account you withdraw funds from might cause your Social Security to get higher or lower. In addition to that, let's imagine for a second you have a brokerage account. Depending upon your income levels, you might be able to take distributions from the account, even sell stocks or mutual funds at a gain and not pay taxes on them. You see, the order in which you withdraw funds does have an impact and can potentially lower taxes in retirement. It's oftentimes a missed opportunity for most investors. You see, because most people, they just want to withdraw the money from the IRAs because, hey, that's what the account is for. And I would encourage you to throw that notion away. Money is money, whether the money is in qualified accounts. Qualified accounts are qualified to pay taxes. Those are IRAs, 457s, 403bs. Money is money. No matter if you saved it for retirement or you just saved it because you had an excess, depending upon the withdrawal order will potentially allow you to minimize taxes. So make tax smart decisions as you're withdrawing those dollars, and it can have an impact on your overall tax bill. So number 3 on our list is tax loss harvesting. Tax loss harvesting is the process at which you sell a position, an investment at a loss, and it enables you to potentially write that off on your taxes or even offset some gains in the portfolio. Let me explain. Let's imagine you bought one share of Apple for $100. That means your cost basis is $100. Now, let's also imagine the market dropped, unfortunately, and now Apple is worth $90. You can sell Apple and then write off the loss of $10. Or you can conversely sell another position to offset that gain. So you can take the loss, apply it to the gain, and then harvest the gain along the way. Tax loss harvesting is a very useful tool to minimize taxes, especially when we're talking about gains in a portfolio. Now, you can't use tax loss harvesting in your 401k or Roth IRA. This is only for non-qualified accounts. Pick your brokerage account or your investment accounts, but tax loss harvesting can be a very powerful tool to help you minimize your taxes in retirement. Number 4 on our list are QCDs, otherwise known as qualified charitable donations. Now, there are some rules around QCDs you need to be aware of before you consider this as part of your overall tax plan and your financial plan. Number 1, you need to be 70 and a half before you're eligible to participate in the QCD. Additionally, it needs to come from your traditional IRA. So first off, let me explain what it is. If you are charitably inclined, a QCD will enable you to send money from your traditional IRA to a charity of your choice, a 503c. The money comes directly from the custodian. It's paid directly to the charity, and you do not pay any taxes on the distribution from your IRA. So if you just take your standard deduction and you're not doing the long form, this can be a really effective way, an effective strategy to minimize your taxes in retirement and still give the dollar, whether it's your church, whether a charity, whatever it is, it enables you to take those dollars from those qualified accounts and make a qualified charitable donation to the charity of your choice. Now, couple caveats and things important to take note of. The check has to be written from the custodian to the charity. It cannot touch your hands. The other part, remember, you need to be 70 and a half before you can participate in the QCD. With that said, it can be an incredibly effective tool to move money out of your qualified accounts into a charity or a church or whatever that is, as long as it's a 503c of your choice. Now, one of the questions I often get on QCDs is, how much can I do? Are there limits on how much I can give via the QCD program? There are. If you're single, the limit is $105,000 in 2024. And if you're married, the limit is $210,000. So be mindful of that as you're building your giving plan and you're addressing QCDs inside of your tax strategy. Now, last but certainly not least on our list, and probably one of the most impactful tools you have, is the potential of a Roth conversion. Let's start with identifying what a Roth is first off. A Roth is a retirement account that allows your earnings to grow tax-free. Now, there are some rules and regulations out around Roths and how long the money needs to stay in the account that you do need to be mindful of before embarking on this strategy. But a Roth conversion, what you're essentially doing is moving money from your traditional IRA to your Roth IRA. When you do your conversion, you are paying taxes on the amount you're converting. Now, the basic premise on why a Roth conversion might make sense is if you believe that taxes will either stay the same or go up in the future, it might make sense to pay taxes on a distribution in today's tax rate on today's dollars, as opposed to potentially paying taxes on those dollars in the future at a higher tax rate. Additionally, when your children inherit this money, or your family or whomever inherits it, they will be required to take distributions out over the course of 10 years. You see, the Secure Act 2.0 changed the math on how distributions from IRAs now have to occur. It used to be that you could take a distribution out based upon your life expectancy. However, today, when you inherit an IRA, you have 10 years if you're not a spouse to withdraw all of the dollars, which potentially makes a Roth conversion or a Roth IRA an even more powerful tool in retirement to minimize taxes. Now, it is important to be mindful of the fact you will pay distributions on Roth conversions as they occur, and to watch out for some red flags. Now, if you're on Medicare, you want to be very mindful not to cause an increase of your premiums via IRMA because you converted too much. So make sure you understand all of the rules, all of the regulations, and all of the pros and cons before you do a Roth conversion. However, if you feel like taxes are going up, a Roth conversion is one of the most powerful tools at your disposal to potentially lower taxes in retirement. So as we recap the 5 simple ways to potentially lower your taxes in retirement, let's start at the top. Social Security optimization. Optimizing your Social Security can have a definite impact, and it is a simple way to potentially minimize your taxes in retirement. The order in which you withdraw funds from your retirement accounts, from your brokerage accounts, has an impact on your taxes. It can potentially help to minimize taxes in retirement. Tax loss harvesting. If you have losses in any of your positions, tax loss harvesting can be a simple way to potentially minimize your taxes. Remember, you can write off up to $3,000 per year, and you can carry forward those losses to write some of the losses off in subsequent years. QCDs, if you're charitably inclined, can be a great way to minimize your taxes in retirement. And last but not least, Roth conversions. If you have money in qualified accounts, considering a Roth conversion as a way to minimize taxes might help you save money in taxes in the future. Hey, I want to thank you for watching today's video. I hope you learned something along the way. If you have any questions, any comments, make sure you leave that down in the comments below. Feel free to subscribe and like our channel. If you want to learn more about me and my firm, visit us on the web at planwellretirehappy.com. And until next week, remember, plan well and retire happy.